Introduce myself. My name is Yelim, a technical manager at KASB, and I'm going to talk about in this session is the adoption of IFRS 17 in the non-life insurance industry in Korea. Sorry? It's not working. Oh, you got it's page 12. Okay. First, I'll divide my presentation into 4 parts. First, I'll discuss the overview of PAA requirements in IFRS 17. And then I'll talk about key accounting policies developed by non-life insurance in Korea. And next, I'll discuss about the practical interpretation issues. And lastly, I'll talk about the response to questions from Nepalese stakeholders. Before diving into PAA, let's begin with understanding the accounting models covered by IFRS 17 and how they apply beyond the non-life insurance sector in Korea. IFRS 17 introduces 3 methods for measuring insurance contracts: the general model, the premium allocation approach, and the variable fee approach. The diagram on the slide reflects an overview of these approaches. The general model, often referred to as the building block approach, is the default measurement model. It is applicable to all insurance contracts unless they feature direct participation or they are eligible and entity choose to apply PAA. Second, the premium allocation approach, which we'll focus on in this session, offers a simplified measurement alternative for contract with a coverage period of 1 year or less. It represents an optional approach for simple and eligible contracts, aiming to achieve outcomes similar to general model, but in a more cost-effective manner. Lastly, the variable fee approach is for insurance contracts with direct participation features. Now let's examine how non-life insurers in Korea utilize these measurement approaches. The general model, being a universal and comprehensive framework, finds application across both non-life and life insurance sectors. In the non-life insurance sector, there is a blend of PAA and GM, reflecting the diverse range of insurance products offered. For instance, the largest non-life insurer in Korea applies 50-50 mix of PAA and GM. In terms of insurance revenue, when it comes to life insurers, they are using both GM and VFA. As we've already discussed the application of IFRS 17 in the life insurers at the last session, I'll skip further explanation about GM and VFA and concentrate on the application of PAA by non-life insurers. At this point, you may wonder, why do general insurers in Korea engage in general model, especially when their main business is short-term business? The answer lies in the unique characteristic of insurance industry in Korea. On the next slide, I'd like to show you how Korean non-life insurers identify their portfolios and introduce practical example to enhance your understanding. In Korea, competition in the insurance industry is intensifying, and that's leading insurance companies to aggressively launch new products. Non-life insurers are selling products that share characteristics with life insurers, such as long-term insurance, and thus blurring the distinction between their area. Let's look at the first table on the slide. It's an overall portfolio scheme defined by the regulatory guidance in Korea. Looking at the table, we can see that non-life insurance companies are offering long-term insurance such as personal accident, disease, property, pension savings, and others. And non-life insurers are using both the PAA and GM. The table below shows a portfolio case of the largest non-life insurance companies in Korea. Business lines and product lines are considered to identify portfolios and accounting model. The company has 3 business sectors: general insurance, car insurance, and long-term insurance. They are divided into 3, and the general sector includes all general insurance except for car, which is managed as a separate sector considering the size of the business line. Within each business line, each type of insurance product is considered an individual insurance risk, and there are a total of 9 portfolios. Moving on to the accounting model, the company uses PAA for general insurance and GM for long-term insurance. As automobile insurance usually has a term of 1 year or less, PAA is applied without any special eligibility test, which we'll discuss later. And similarly, as most other non-life insurers has a term of 1 year or less in general, PAA is applied as well. In the case of contracts exceeding 1 year, such as long-term insurers, you can see that GM applies unless they do not pass the similarity test. I shared a brief overview of the business and portfolio of general insurers in Korea. Next, I'll give you an overview of PAA requirements in IFRS 17. As I understand that all of you have a basic understanding of IFRS 17, I didn't go into detail about the concepts of the eligibility test or the similarity test when explaining this slide. If anyone is curious about those concepts, please pay attention as I'll be covering them right now. Let's explore the components of PAA liability by comparing it with GM. Unlike GM, which measures LRC using 4 components, the premium allocation approach measures the liability for remaining coverage by reference to the premiums received. It is similar to earned premium approach currently used in many jurisdictions, where the measurement of LRC might be simplified by allocating premiums over the coverage period. And the liability for incurred claims is measured on the same basis as GM. And the calculation of RA may be challenging because it includes a variety of factors and sophisticated assumptions. Unfortunately, under PAA, there is no need to calculate RA for LRC, simplifying the complex estimation issues. Now, let's proceed to discover the conditions under which this simplified method can be used, and what the eligibility requirements are. Our current slide provides a visual decision tree to help determine PAA eligibility. First, we can assess whether the coverage period is 1 year or less. If it is, insurers can choose to apply PAA without a further test. An additional test is required when the coverage is more than 1 year. This involves assessing whether the PAA produces a measurement of liability that is not materially different from the liability produced by the GM calculation. This test is also known as a similarity test, which means that it's an analysis of how similar the patterns are between the liabilities calculated under GM and PAA. If the results are not materially different, in other words, if they are similar, then PAA can be used. If not, the liability for remaining coverage must be calculated using GM. Developing accounting policy is crucial for PAA because the same contract may or may not qualify for PAA depending on the policy that entity has adopted. This highlights the importance of establishing criteria for passing the second criterion, the similarity test. With many general insurers now providing multi-year contracts, especially in business lines related to engineering and construction, these contracts, unlikely to meet the first one-year criterion, must be carefully assessed against the second criterion to ensure they fall within the scope of PAA. More details on practical accounting policies will be provided in the second chapter. According to paragraph 54, with respect to the second eligibility requirement, there should be no significant variability in the fulfillment cash flows before the claims are incurred from the inception of the group of contracts. If an entity expects significant changes in the estimates of fulfillment cash flows before claims are incurred, PAA cannot be applied, and the general model must be applied. I received a question about the case where there is significant variability in the liability measurement values between GM and PAA, and I believe that the paragraph 54 would be a sufficient answer to that question. Let's move on to the level of aggregation. Basically, for PAA, the same level of aggregation is applied as that of GM. First, an entity shall identify portfolios of insurance contracts. A portfolio comprises contracts subject to similar risk and managed together. And next, the second step is to divide the portfolio into a minimum of 3 groups, distinguishing different levels of profitability. For contracts issued to which an entity applies PAA, an entity shall assume no contract in the portfolio are onerous at initial recognition unless facts and circumstances indicate otherwise. Last but not least, IFRS 17 requires a portfolio of contracts to be divided into annual cohorts. Let's move on to the next slide about the measurement overview. Insurance contracts are measured using 2 main components: the liability for remaining coverage and the liability for incurred claims. The liability for remaining coverage, LRC, is an entity's obligation to investigate and pay valid claims under existing insurance contracts for insured events that have not yet occurred. In other words, it is the obligation that relates to the unexpired portion of the coverage period. The liability for incurred claims is an entity's obligation to investigate and pay valid claims for insured events that have already occurred. This includes events that have occurred but for which claims have not yet been reported, along with other incurred insurance expenses. The liability for remaining coverage may consist of non-loss component and loss component. The loss component can be identified based on the division into groups that I explained previously. I'll explain the measurement of insurance liability divided into 3 sections. Firstly, I'll cover the general requirements related to the measurement of LRC, focusing on the non-loss component. Secondly, I'll examine the measurement of the loss component. And finally, I'll discuss the measurement of LIC. We're now going to explore the initial measurement of the liability for remaining coverage. To calculate the liability for remaining coverage, we begin by adding the received premiums, then we deduct the insurance acquisition cash flows. Additionally, insurance acquisition cash flows recognized either as an asset or liability are adjusted by either adding or deducting them. Let's have a closer look at each component. Received premiums refer to the actual premiums received. In this respect, there was a question submitted for TRG agendas asking whether uncollected premiums should also increase the liability. And TRG concluded that the premiums, if any, received at initial recognition, as included in paragraph 55, means premiums actually received at the reporting date. It does not include premiums due or premiums expected. Next, the insurance acquisition cash flows are defined as cash flows arising from the cost of selling, underwriting, and starting a group of insurance contracts. Applying the practical expedient outlined in PAA requirements, entities can immediately recognize this cost as an expense if the contract's term is 1 year or less. When not expensed immediately, insurance acquisition costs cash flows are deducted from the insurance liability. And any other asset or liability previously recognized for acquisition cash flows relating to the group of contracts are added or deducted from the liability. If there was a cash outflow, it would have been recognized as an asset, and if there was a cash inflow, it would have been recognized as liability. The subsequent measurement of the liability for remaining coverage begins with the opening balance, to which we add received premium. If contracts have a significant financing component, an adjustment for the time value of money is applied, accruing interest using the discount rate determined at initial recognition. By applying a practical expedient, if an entity expects that the period between providing each part of service and the related premium payment due date will be 1 year or less, it becomes unnecessary to adjust for financing components, regardless of its significance. And subsequently, the amount recognized as insurance revenue and any investment components transferred to liabilities for incurred claims are deducted. Following this, insurance acquisition cash flows are also deducted. Another practical expedient allows for the immediate expensing of acquisition costs when the coverage period is no more than 1 year. If these costs are not expensed immediately, their payment is deducted from the liability and recognized as an insurance service expense over the coverage period. Let's visualize the fluctuations in the liability for remaining coverage with a graph that clearly demonstrates the increases and decreases. This slide makes it easy to spot practical expedients as they are outlined with a dotted line. Furthermore, items impacting profit or loss are enclosed in a red box, so please make sure to check them. Initially, the received premium is added to the opening balance, resulting in an increase to the liability. If there is a significant financing component, the liability is then adjusted to reflect the time value of money and the effect of financial risk. Insurance revenue is recognized for the coverage provided within the reporting period, which in turn reduces the liability. Expected premium receipts are recognized in profit or loss over time, reflecting either the passage of time or the expected timing of incurred claims and benefits, if the release pattern of risk is significantly differs from the passage of time. Insurance revenue following time-based recognition can be allocated consistently on a monthly or daily basis, aligned with the service period. Conversely, with risk-based recognition, insurance revenue can be allocated based on the risk release pattern, such as historical loss experience patterns or expected loss ratios. After this, any investment components transferred to liabilities for incurred claims are deducted, leading to a decrease in liability. Lastly, insurance acquisition cash flows are recognized, reducing the liability when entities do not apply the practical expedient. In summary, PAA is a simplified measurement approach that can be used for LRC if certain criteria are met, providing a practical expedient. It's simpler because there is no need to calculate cash flows and update estimates compared to GM. I'd like to introduce the noteworthy insights from Korean non-life insurers when developing accounting policies. This is particularly relevant for practical experience within PAA. For instance, paragraph 56 states that an entity shall reflect the time value of money and the effect of financing components only when the contracts have a significant financing component. As the standard does not, furthermore, if the time between providing each part of services and the related premium due date is no more than a year, entities are not required to reflect time value of money. However, there could be cases where time value of money is not reflected, even in contracts exceeding 1 year, due to issues related to significance. As the standard does not provide a specific definition of significance, entities are required to define significance. This involves considerations of materiality, essentially questioning how significant is significant. In fact, by establishing accounting policies on significance, most non-life insurers applying PAA in Korea consequently do not account for the financing component in insurance liabilities. In addition, regarding insurance acquisition cash flows, according to paragraph 59, if coverage period is no more than 1 year, acquisition costs can be expensed when incurred, depending on entity's accounting policy. On insurance acquisition cash flows are deducted from the insurance liability when not expensed immediately. This accounting policy choice can affect the amount of insurance liability. From the perspective of a group, whether the group is identified as an onerous group will depend on the total amount of insurance liability for the contracts within the group. Therefore, it is noteworthy that the accounting policy on insurance acquisition cash flows can affect the number of onerous groups, potentially influencing the company's profit or loss. In summary, establishing an appropriate accounting policy is essential under PAA. Details on specific policy examples will be discussed on the chapter 2, so please look forward to the discussion. Moving on to the next section, let's examine the measurement of onerous contracts. Here is a recognition process for onerous contracts. An entity will follow 2 steps to initially recognize a contract. As a first step, an entity identifies portfolios. And as a next step, an entity divides the portfolio into groups based on the level of profitability. Profitability groups should generally be determined on an individual contract basis. However, if an entity has reasonable information to conclude that a set of contracts share the same profitability, they can be assessed collectively. For instance, motor insurance policies for a specific demographic can be evaluated together if they are expected to fall within the same profitability group. When a group of contracts becomes onerous, such as Group C in the slide, a loss is recognized immediately. Within a single portfolio, sometimes only one of 3 profitability groups may be needed, especially if all contracts are assessed as neither onerous nor significantly at risk of becoming onerous. Now let's examine the framework for identifying onerous group. Under PAA, identifying onerous contracts is simpler than under GM, as continuous cash flow calculation are not required. Instead, an initial assessment based on facts and circumstance is sufficient. When indications suggest that a group of insurance contracts is onerous, entities are required to compare the carrying amount of liability for remaining coverage with the fulfillment cash flows. The carrying amount of the liability for remaining coverage would be measured by PAA, while the fulfillment cash flows would be measured using building block approach, calculating estimated future cash flows and risk adjustment. If the fulfillment cash flows are greater than the carrying amount of PAA liability, a loss component is indicated, and such a loss is recognized immediately. The amount of loss is measured as the difference between the two. This amount is then added to both the insurance expense and the liability for remaining coverage. This simple example on the slide illustrates the calculation. It shows a loss of 300, which is the difference between the liability for remaining coverage and fulfillment cash flows. Subsequently, the entity remeasures the loss component until it becomes zero. Because the loss component is a part of liability for remaining coverage, it must be zero at the end of the coverage period. This requires an accounting policy decision on how to systemically allocate the loss components over the remaining coverage period. In Chapter 2, I'll elaborate on practical accounting policy alternative regarding this allocation. In the following slides, let's examine how to measure liability for incurred claims. The liability for incurred claims is the obligation to pay claims that have already incurred during the coverage period. The measurement of the liability for incurred claims is consistent with GM. It comprises of the present value of expected cash flows and risk adjustment for non-financial risk. Insurance service expenses are recognized at the time of occurrence of claims or expenses, and the incurred claims liability is increased. An entity will discount expected cash flows to account for the time value of money and financial risk. The discount rate should be current, market-based, and should reflect characteristics of cash flows and liquidity. And as additional simplification for PAA, IFRS 17 provides practical expedients related to discounting of LIC. Discounting not required when cash flows are expected to be paid within 1 year or less from the date the claims are incurred. When there is an investment component, the liability for remaining coverage will decrease, and the liability for incurred claims will increase by the amount actually incurred. As only the amount actually incurred is recognized as LIC, the model does not account for differences between expected and actual investment components. As for risk adjustment, entities apply the same requirements applied to GM. The risk adjustment represents the compensation the entity requires for bearing the uncertainty arising from non-financial risk. For LIC, the risk adjustment reflects the unexpired portion of non-financial risk for claims not yet settled. The uncertainty measured by the risk adjustment could be related to timing or the amount of payment of claims or both. Although IFRS 17 does not specify how to measure the risk adjustment, it requires that it should be an entity-specific, explicit manner. When measuring RA, the discount rate used in the same one applied to measuring future cash flows. Under IFRS 17, an entity has an option to allocate changes in the RA between the insurance service result and insurance finance income and expenses. It's in line with the requirements in the general model under IFRS 17. If an entity chooses not to disaggregate, these changes are recognized entirely as insurance service expenses. Now let's turn our attention to the presentation and disclosure requirements. We'll begin with the key changes IFRS 17 introduces to the balance sheet. Traditionally, a group of insurance contract would appear as a separate line item in both the asset and liability sections of the balance sheet. For instance, as illustrated on the slide, there would typically be a line item for deferred acquisition costs and policy loans on the asset side, and another for unearned premium and liabilities. With the application of IFRS 17, this presentation is streamlined. The entity will present the group of insurance contracts as a single line item representing a collective set of rights and obligations. This means that a single group of insurance contracts could reflect an asset position, such as when acquisition costs are paid upfront before any other cash flows. However, it is more common for a group of insurance contracts to be in a liability position, given that the entity usually receives premium in advance for coverage that will be provided in the future. It's important to remember that over its lifetime, a group of insurance contracts may fluctuate between an asset or a liability position. Additionally, it's noteworthy that the entity will present reinsurance contracts separately from its insurance contracts. Now, let's proceed to the statement of financial performance. Under IFRS 17, investors will have access to more detailed information, as it will distinguish between two profitability drivers, the insurance service result and the net financial result. This distinction will reflect how successful an entity is in providing insurance activities versus investment activities, which was often not available under IFRS 4. Considering IFRS 17, the insurance service result will include insurance revenue, which reflects the provision of coverage and other services arising from a group of insurance contracts and will be reduced by insurance service expenses. These expenses will cover incurred claims, amortization of acquisition cash flows, and changes in estimates related to claims that have already been incurred, as well as adjustment for onerous groups. Turning to financial aspect, the insurance finance result will consist of insurance finance expenses offset by investment income. And investment income is recognized and measured according to other standards, such as IFRS 9, which provides the guidelines on how financial assets and financial liabilities should be accounted for. Insurance finance expense reflects the time value of money, meaning it accounts for the fact that the money available now is worth more than the same amount in the future. It also reflects the financial risk associated with the insurance contract, such as changes in discount rates. The difference between these two items, insurance finance expense and investment income, represents the insurance financial results. Overall, non-life insurers are expected to see fewer changes in the statement of financial performance compared to life insurers. And the major change for life insurers will be reporting investment activities separately from the insurance activities. Under the premium allocation approach, other comprehensive income can arise from liabilities for incurred claims. IFRS 17 offers entities a choice in how they account for and present insurance finance expenses related to insurance liabilities. Specifically, they can choose to recognize all such expenses in the profit or loss, or to disaggregate these expenses between profit or loss and other comprehensive income. It is consistent with the requirements in GM. If an entity chooses to disaggregate the insurance finance expense, the portion of insurance finance expenses allocated to profit or loss reflects a systemic allocation of total insurance finance expenses over periods. This allocation is based on the locked-in discount rate as of the date the claims were incurred. Essentially, it is insurance finance expenses that would have been arisen if the locked-in rate was applied to the liability over the period. Whereas in other comprehensive income, the entity will present the difference between the insurance finance expenses recognized in profit or loss and the actual impact of current discount rates on the liability for incurred claims as they are measured on the balance sheet. This is because the liability for incurred claim is remeasured using current discount rates, capturing the effect of financial markets and changes in the time value of money since the claims were incurred. Please note that the option to present finance expenses in OCI only applies to the LIC. For the liability for remaining coverage, since it uses locked-in rate from the date of initial recognition for interest accretion and rates are not updated, there is no need to disaggregate finance expenses between profit or loss and OCI. Now let's turn to the disclosure slide. When using the simplified approach for contracts, entities are not required to provide the same extensive range of disclosure as they would under general model. Given the simplified nature of the model, as we've discussed, entities using PAA will not have detailed information typically associated with components like the present value of future cash flows, the risk adjustment, or the contract service margin. However, there are still specific disclosure requirements associated with the simplified approach. Firstly, entities need to disclose the criteria that make contracts eligible for the simplified approach. Eligibility can be met through either the coverage period of the insurance contracts or a similarity test. Secondly, entities need to disclose any practical expedients that have been applied. This includes whether an adjustment has been made for the time value of money and the effect of financial risk, as well as the methods they have chosen to recognize insurance acquisition cash flows. So in the following chapter, I'll provide different accounting policy options for non-life insurance companies under IFRS 17, particularly in the application of premium allocation approach. As previously mentioned in the overview of Chapter 1, there are certain areas where an entity has discretion in developing accounting policies. The development and application of accounting policies involve not only considering the impact of the financial statements, but also the costs associated with adopting and maintaining these policies. Although the decision-making process requires careful consideration, it enables companies to make strategic decisions and establish efficient management. The following chapter are based on interviews with practitioners and specialists from the non-insurance industry in Korea. And personally, I hope this information serves as a valuable resource for stakeholders in Nepal as well. The first topic is significant risk. For a contract to fall within the scope of IFRS 17, a transfer of significant insurance risk from the policyholder to the issuer is required. According to IFRS 17, an insurance contract is defined as a contract where one party accepts significant insurance risk from another party by agreeing to compensate the policyholder if a specified uncertain future event adversely affects the policyholder. The assessment of whether a contract transfers significant insurance risk is critical because some contracts may appear to meet the definition of an insurance contract, but are not considered to be insurance contracts for the purpose of IFRS 17 because the insurance risk transferred is not significant. Therefore, entities may need to exercise judgment in this area. In Korea, the concept of the additional benefit premium rate is utilized to assess the significance of insurance risk. This rate is a ratio representing the difference between the amount paid when an insured event occurs and the amount paid when no such event occurs. The additional benefit premium equals the difference between the payment made when no insured event occurs and the payment made upon the occurrence of an insured event. The payment made upon the occurrence of an insured event refers to the total sum of benefits paid to the policyholder, such as insurance and annuity payments upon such an event. The payment made when no such event occurs includes the total of payments made regardless of insured events, including surrender value. A higher additional benefit premium rate indicates a stronger risk protection function of the insurance contract. Therefore, entities may establish a certain threshold to determine whether the insurance risk is significant. One way is to calculate the additional benefit premium rate and assess whether the rate exceeds a certain threshold. The additional benefit premium rate is calculated as the additional benefit premium divided by the payment made when no insured event occurs. This approach aligns with regulatory guidance in Korea as well, which sets the threshold at 10%, implying that a rate above 10% is considered significant. From my understanding, insurance companies globally applying IFRS 17 are considering a range from 1% to 10% for this assessment. The second topic is the identification of portfolios. I've received several questions about portfolios and groups from Nepalese stakeholders in Korea. Fundamentally, a portfolio comprises contracts that are subject to similar risk and are managed together. Given the diversity of insurance contracts and the uniqueness of each portfolio, it's unlikely that universal guidance for the definition of similar can be provided, making the decision process is likely to be entity-specific. In Korea, the interpretation is that the risk includes insurance risk. Practically, in non-life insurance, this means portfolios are often divided based on the main coverage offered. Furthermore, in Korea, there are specific portfolios defined for supervisory purposes according to regulatory guidance, particularly detailed in the detailed regulations on supervision of insurance business Appendix 35. When IFRS 17 was first introduced, a task force consisting of specialists from financial supervisory service, the insurance industry, and accounting firms was formed to determine the appropriate level of portfolio classification. After much discussions, a consensus was reached, and most insurance companies within the industry have since adopted this level of aggregation. While each company's product line differs, not all companies maintain the full range of insurance product portfolios presented. However, in anticipation of future product diversification, most companies have systemically designated unique management codes for each portfolio in their management systems, even for products they do not currently offer. Paragraph 16 of IFRS 17 requires entities to divide a portfolio of insurance contracts into groups, reflecting profitability, but there is no specific guidance for this segmentation. Entities are therefore reasonable for establishing and consistently applying their own criteria for such grouping. I remember in the last session, the same content was included, but let me tell you more specifically. So utilizing the concept of confidence level, which is used to quantify risk adjustment for non-financial risk as a method to differentiate between groups, is recognized practice in Korea. For instance, if risk adjustment is calculated using a confidence level, say 1 RA, this could be considered a standard threshold. In this context, double RA or 2 RA would represent a more conservative confidence level. The confidence level essentially measures the likelihood that an estimate falls within the confidence interval. So a 75% confidence level would mean that there is a 75% probability that the true value lies within the interval. Since 2RE has a wider confidence interval, it can be considered a more stringent confidence level. Given that the sum of the best estimate liability and the risk adjustment is equivalent to the CSM, a negative value means that CSM is minus, indicating an onerous contract. If the estimated future cash flow amount derived at 1RA is less than 0, such a contract is considered onerous. Should the estimated future cash flow amount derived at 2RA exceed 0, then the contract is considered profitable because it has surpassed the financial threshold determined at a higher level of confidence. Contracts that fall within the intermediate range are classified as a group called others. These contracts are regarded as potentially onerous groups, which practically means careful of being onerous, but still non-onerous. This flowchart illustrates possible decision tree that entities may adopt for grouping of insurance contracts, as I explained in previous slide. If after applying a 1RA confidence level, the CSM is negative, the contract is considered loss-making. Conversely, if the CSM at the 1RA level is positive, it's classified as non-loss-making. But we need further categorization to determine if it belongs to a group of no significant possibility of becoming onerous, which typically means certainly profitable contracts. Moving to a higher and more conservative 2RA confidence level, if the CSM remains positive even at the 2RA confidence level, this indicates that the contracts are likely to be profit-generating, thus considered as a group of no significant possibility of becoming onerous. If the CSM turns negative at the 2RA level, these contracts fall into others group. They are not considered onerous at present, but are subject to monitoring due to their potential risk of becoming onerous in the future. The next topic is how to establish the accounting policy for onerous contracts assessment. Paragraph 57 of IFRS 17 states that if at any time during the coverage period, facts and circumstances indicate that a contract is onerous, an entity shall review the possibility of an onerous contract. However, as the standard does not specifically define what these facts and circumstances are, it is left to the entity to establish an accounting policy determining the cycle for assessing onerous contracts. Possible alternatives for identifying the timing for calculating potential losses include following. One approach is the use of quantitative benchmarks such as the combined ratio. To explain briefly, the combined ratio is the addition of the loss ratio and expense ratio. It is calculated by summing up incurred claims and incurred expenses, and then dividing this total by earned premiums. A combined ratio exceeding 100% can signal potential losses. Another option for entities is to conduct periodic assessment at the end of each reporting period. By periodically assessing contracts, entities can address the issue of qualitative judgment in interpreting what facts and circumstances mean and the integration of operational strategies for profit management. IFRS 17 does not prescribe how to allocate the loss component over the remaining coverage period, leaving entities to decide on appropriate method of systemic allocation. Possible alternatives include followings. Allocating the loss using the loss ratio, which is consistent with GM, and allocating the loss according to the liability for remaining coverage movement pattern under PA approach, and recognizing or reversing the loss based on the recalculated amount. It is important for insurers to apply a consistent allocation policy from period to period to ensure consistency in the assessment and reporting of onerous contracts. Paragraph 53 of IFRS 17 requires an assessment to determine whether the premium allocation approach can be applied. This assessment, also known as similarity test, involves comparing the liability measured under PAA and the liability measured under GM. To ensure that they would not differ materially. To achieve this, companies must design the test to verify that the two liabilities are of reasonable approximation of each other. The first issue that arises is testing for groups with mixed coverage durations. When the group of contracts include both those with coverage periods of less than 1 year and those exceeding 1 year, determining whether such mixed group should be included in the testing process could be challenging. Companies might consider several accounting policies for this situation, such as evaluating all contracts within the group to ensure a comprehensive coverage assessment, determining the ratio of contracts that exceed 1 year duration within the group, and performing testing for groups above a specific threshold, and initiating testing when at least one contract in the group exceeds 1 year. Another issue is determining materiality in the similarity test. Specifically, the question arises, to what extent can differences between liabilities calculated under BBA, GM, and PAA still be considered not materially different? One possible solution is to use the BBA liability as a benchmark. However, this approach may not always be suitable, particularly in cases where the variability of the GM liability is high. For instance, consider a scenario where at initial recognition of an insurance contract, the unearned premium is 100 and the expected future claims amount to 95. In this scenario, the liability under BBA would calculate it -5, leading a certain percentage of BBA liability on inappropriate benchmark due to its negative feature. In circumstances where the BBA liability demonstrates significant variability or does not provide a suitable measure, alternative benchmarks may prove more suitable. For example, Korea's largest general insurer is using an insurance total premium as a benchmark. It means that if the difference in liabilities is less than 5% of total premium, it is considered that PAA would produce an LRC that would not materially differ from the LRC produced under GM, and thereby applying PAA. Please note that the suggested percentages such as 10% or 5% are just examples, and companies should establish their entity-specific accounting policies based on the principles outlined in IFRS 17. The reasonable approximation test can be also conducted using quantitative criteria, but it's also possible to assess the similarity test through qualitative analysis. The difference in liability pattern basically translates to differences in liability amortization, which in turn affects revenue recognition. The graph shown in the slide illustrates the amortization patterns of PAA and BBA liabilities over the coverage period. PAA liabilities are represented by a blue line, and BBA liabilities are represented by an orange line. You can observe that patterns of both liabilities are nearly identical throughout the period. This analysis requires performing cash flow estimation just once at the initial recognition of the insurance contracts, offering the relative advantage of alleviating difficulties to constantly estimate and update cash flows throughout the period. As the liabilities measured under both methods fluctuate in a manner that leads to a similar revenue recognition, This demonstrates that the nature of both liabilities would not materially differ. Thus, I have introduced this analysis as qualitative testing. Then, how should we interpret the potential failure indicated in the graph? To what extent is potential failure acceptable? It depends on the entity's accounting policy, guided by judgments of materiality. Now, let's proceed to the next slide to expand our understanding of the revenue recognition methodology for insurance contracts under PAA. Applying paragraph B 126, an entity recognizes the insurance revenue for the period as the amount of expected premium receipts allocated to the period. The expected premium receipts are allocated to each period of coverage either on the basis of passage of time or on the basis of the expected pattern of risk release. For time proportional methods, the options include daily rate, monthly rate, and etc. On the other hand, in cases where the patterns of risk release during the coverage period significantly differs from the passage of time, a risk proportional method should be applied. This method may involve the recognition based on patterns of past claims experience, expected future loss ratios. In addition, simplified methods such as the sum of days methods are also acceptable alternatives. It aggregates the number of days a particular contract exposed to risk over a period of time, allowing the risk to be assessed as it accumulates over time. The use of simplified methods allows standardization of pattern of revenue recognition, which leads to predictable financial results and efficient management. Now, moving on to the next slide, let's further examine revenue recognition method with an example. Consider a contract with a coverage period of 5 years. Using the time proportional revenue recognition method to determine the amount to be recognized as insurance revenue for the period results in an annual recognition rate of 20%. Alternatively, a calculation based on the pattern of risk release could be used. Although there are various methods that take into account the pattern of risk release, in this case, the sum of days method as a simplified approach was used. The amount of revenue recognized at time point I is calculated by dividing I by the sum of the number of days from day 1 to day n of the coverage period, and then multiplying by the total expected premium received. Here, for example, in the first year, I represents 1 and n represents 5, under the assumption that there is no significant financing component and that days are calculated by year. As illustrated in the cumulative return graph below, the time proportional method provides consistent revenue recognition, while the risk proportional approach allows for incremental revenue recognition as time progresses. Simplified methods may be appropriate for scenarios like construction and assembly projects where there is a notable variation in risk exposure over time. Insurance contracts pertaining to construction sites or product assembly, which often extend beyond a 1-year coverage period, may be suitable for such methods. However, in order to apply such method, it may be necessary to ensure that the claims experience pattern does not significantly differ from this expected pattern. If the contract's term is 1 year or less, insurance acquisition cash flows can be recognized immediately as an expense, applying the practical expedient provided under PAA. I remember this topic was included in your questions. If the option to recognize insurance acquisition costs immediately is not chosen, then insurance acquisition cash flows must be deducted from the liability and allocated on a systemic and rational basis over the coverage period. And this requires an entity to determine an accounting policy on how to allocate acquisition costs. One approach is to allocate the total expected insurance acquisition costs over the entire coverage period. This method is advantageous in that it aligns with the revenue recognition pattern of premiums. However, it involves the complex task of estimating the total insurance acquisition cash flows over the coverage period and requires the development of an accounting policy for experience adjustment. Experience adjustment for insurance acquisition cash flows are defined as the difference between the estimate at the beginning of the period of the amounts expected in the period and the actual cash flows in the period. An alternative approach is to allocate the actually incurred insurance acquisition costs over the remaining coverage period. This method does not necessitate the total insurance acquisition cash flows, but may lead to a mismatch between revenue and expenses, as costs are recognized only over the remaining coverage period after the costs actually occur. To address these practical application issues, entities might consider adopting an accounting policy that recognizes the cost of actual insurance acquisition cash flows over the remaining period, in line with the movement pattern of PAA LRC. This is analogous to the method used in GM, as you're aware, where entities align the allocation of insurance acquisition costs with the allocation pattern of contractor service margin. Now I think it's time to have a break. We'll have 20-minute break. Like one or the white one.
Sorry, I made a mistake. I misunderstood that your chairman is an interview after the interview process. Ah, sorry.
No, it is an invitation. You don't have to congratulate.
Yeah, sorry.
It is a bit lagging, right? So could you manage with this?
So the exact one is the right in the middle or the left?
No, it is in the back.
Back?
Yeah. Could you see the guy with the hat?
Right
Yeah.
on the right one.
Yeah, on
Yeah,
the right.
yeah.
So he is having that. Actually, this device is connected in a laptop, and that laptop is on the back. So
It's not working.
yeah,
Uh, what?
no worries. So I'll just make sure if it is not working, they will change it by themselves. Okay.
But I'm wondering pages go and go again. I want to go pages.
Yes, sure. I mean, you could just try it, and sometime if it is not working, then they will change it. Okay. Only one slide at a time. Okay. You are doing good.
Welcome back, everyone. We are reconvening now, so please rejoin the program at your earliest convenience. Thank you.
Yes. Right now. Okay. Hello. We're now commencing with chapter 3. The focus here is on the interpretation issues that arose in Korea and the conclusions. In Korea, in our ongoing efforts to facilitate the adoption of IFRS, we at KASB have been offering technical inquiry and response services regarding KIFRS. As many of you are aware, IFRS 17 was officially implemented in Korea on January 1st, 2023. We encountered a series of practical questions about accounting for insurance contracts under IFRS 17. In the upcoming chapter 3, I intend to share the specifics of these issues and how we have addressed them and reached a consensus before adopting the new standard. First, I'll explore the background behind the issues and identify the main issue. Next, I'll examine different perspectives and share the conclusion we reached along with the rationale behind them. I hope our experience will provide you valuable insights. And I think this content might be a little bit challenging for you, so I recommend you to read again after this presentation. Moving forward, let us address the first issue, unit of account and revenue recognition method in applying the premium allocation approach. The issue arises from the practices of some insurers in applying the PAA, wherein insurance liabilities are measured on a contract basis and insurance revenue from individual contracts is aggregated for the purpose of group accounting. This accounting practice is based on the assumption that the results calculated on an individual contract basis are not materially differ from those calculated on a group basis. Premiums are therefore recognized as revenue by aggregating the amounts from each contract. And for contracts that are surrendered before maturity, the remaining premiums, net of surrender values, are calculated on a contract-by-contract basis and recognized as a sum of group accounting. It may be difficult for you to understand the intent of the question. This is because IFRS 17 clearly defines the unit of accounting as a group. The genesis of this question lies in the fact that Korean insurers have, even before the introduction of IFRS 17, been managing contracts on an individual contract basis for operational purposes. The key issue identified was, what is the appropriate unit of accounting and revenue recognition method when applying the PAA to measure insurance contract liabilities and recognize insurance revenue. Perspective A argues that insurance revenue and liabilities should be recognized based on a group of insurance contracts, with revenue recognized over the passage of time or according to the timing of incurred insurance services expenses if the expected pattern of release of risk differs significantly from the passage of time. Perspective B advocates for recognition based on individual contracts, with the results aggregated to measure the insurance revenue and liabilities for the group of insurance contracts. It assumes that if there is no material difference between the liabilities measured individually and those measured for the group, revenue should be recognized on a passage of time basis. The conclusion is clear that the unit of account is a group. An entity is required to allocate the expected premium receipts on the basis of the passage of time or the expected timing of incurred insurance service expenses if the expected pattern of the release of risk during the coverage period differs significantly from the passage of time. This method of revenue recognition should be determined by assessing all relevant facts and circumstances of the insurance contract. The rationale is as follows. According to IFRS 17, it is clarified that the unit of account for recognition and measurement is a group of contracts as stated in paragraph 24, and the principle applies to both GM and PAA without exception. The rationale behind grouping stems from a fundamental aspect of insurance activity, which involves issuing a large number of similar contracts to mitigate risk. Consequently, the level of aggregation becomes an important factor in the accurate representation of entities' financial performance, as noted in IFRS 17, paragraph BC 51. Furthermore, the difference in accounting results depends on the level of aggregation. This is because amounts that would naturally offset each other within the measurement of a group of insurance contracts might be treated differently and hence not offset each other if contracts were measured individually, as highlighted in IFRS 17 paragraph BC 1105. Okay, let me illustrate how accounting outcomes can vary depending on the level of aggregation with an example. We have two insurance contracts, Contract A and Contract B. Both contracts have a coverage period of 3 years and an insurance premium of $1,500. The claims actually incurred and key assumptions are as follows. First, let's follow the approach of View A, calculating on a group basis. Insurance revenue totals $3,000, comprising $15,000 from Contract A and $1,500 from Contract A and B. Revenue recognition based on the passage of time amounts to $1,000 recognized each year. Insurance expense is calculated by aggregating the claims incurred each year for each contract. As a result, the insurance service results show us a profit of $300 in the first year and breaks even with $0 in the second and third years. If we follow the approach of View B, calculating on individual contract basis, the annual profit or loss would be as follows. The total premium of Contract A is $1,500. Spread over the years, this gives an insurance revenue of $500 per year. Deducting the actual claims incurred gives us the annual profit or loss. Moving on to Contract B, the premium is also the same as for Contract A, and the total claims incurred is $1,800, which exceeds the total premium. The excess of $300 loss component and should recognize as a loss at the initial recognition. Assuming that the loss component is evenly distributed over each year, the insurance revenue for the first year would be adjusted to 600, and the insurance service expense would increase from 400 to 700 as a result of the adjustment for the onerous contract. This demonstrates how accounting results can differ between calculations on a group basis and individual basis. Despite any systemic issues companies may face, the current IFRS 17 standard explicitly specifies the unit as a group of insurance accounts without exception. To summarize, given the purpose of defining units as a group, the absence of exceptions, the differences in accounting results, and the impact of offsetting effects among contracts, we concluded that it is not justified to assume that the sum of several contracts is equivalent to a group of contracts. The second issue is accounting for changes in risk adjustment for non-financial risk. Although I provided an overview of PAA in my earlier presentation, this issue pertains not to PAA, but to the application of general model. Regarding general model, paragraph B96 lists the items that need to be adjusted into CSM and for changes in fulfillment cash flows that relate to future service. In this context, B96D refers to the changes in the risk adjustment for non-financial risk. The issue arises from the practice of some insurers when they apply paragraph B96D. This is because paragraph B96D provides entities with an option for the disaggregation of changes in risk adjustment for non-financial risk. In other words, if an entity decides not to separate the changes related to non-financial risk from the effects of the time value of money and its changes, both adjustments shall be adjusted for CSM. As a result of the entity's decision not to disaggregate the RA, the pure effect of time value of money is recognized as an adjustment to CSM rather than P&L. The issue arises when considering paragraph B96 along with B97 because paragraph B97 requires the effect of a change in the discount rate to be recognized as P&L rather than CSM. This requirement is based on the assumption that changes in the discount rate are not related to future service and therefore require recognition in the current period profit or loss. This is very straightforward. The inquiry seeks clarification on whether, despite the guidance in paragraph B97, entities are allowed not to recognize the effect of the time value of money in profit or loss. If entity chooses not to separate the time value effect from the pure risk adjustment effects in accordance with B96D. There are two different perspectives on how to account for the changes in RA due to the time value of money effect if entities choose not to disaggregate changes in RA. You can check this paragraph on the second line in the slide. The effect of the time value of money and changes in the time value of money as specified in B96D. View A supports for P&L because these changes result from the current discount rate changes, which reflect a pure time value effect. These changes occur even without a change in the risk adjustment for non-financial risk. Conversely, View B suggests that if these effects are not disaggregated in accordance with B96D, they should be adjusted in CSM. This view is based on the understanding that the effect of a change in discount rate as per B97 is included in the time value of money and its changes as per B96. Therefore, View B argues that the effects of changes in the discount rates do not need to be independently separated and recognized in P&L. KASB concluded that it is appropriate to adjust for all changes in non-financial risk related to future service within CSM. This stance is in line with View B. In the April 2019 ISB staff paper, it is mentioned that paragraph B96 of IFRS 17 does not address the treatment of changes caused by the time value of money and financial risk if they are disaggregated. But it is concluded that there are clear guidelines for accounting for changes in the risk adjustment for non-financial risk, specifically addressing the effects of the time value of money and its changes, and the effect of financial risk and its changes. And in the staff paper, it is further noted that paragraph B96 could be amended to clarify that such guidelines, as outlined in paragraph B97, could also be extended to apply to B96D. It means that B97 applies to time value of money effects as per B96 only when there is disaggregation. Conversely, if there is no disaggregation, it follows the guideline of B96 and recognized in CSM. The KASB has reviewed the structure of the paragraphs in IFRS 17 to reach a clear conclusion. According to paragraph 37, an entity shall adjust the estimate of the present value of the future cash flows to reflect the risk, which is the compensation that the entity requires for bearing the uncertainty that arises from non-financial risk. Fulfillment cash flows consist of those two: present value of future cash flows and risk adjustment. And moving on to the paragraphs of application guidance, B96 is set out on how to account for changes in fulfillment cash flows, in which B96P and B96D respectively pertain to changes in estimates of the present value of future cash flows and changes in the RA. Paragraph B96B states that adjustment to the present value of future cash flows shall be accounted for within the CSM, excluding those outlined in B97. And B97 refers to the changes in the fulfillment cash flows, specifically the effect of the time value of money and the effects of financial risk and other changes. It means that the paragraph B96 leaves no discretion to the reporting entity because the time value effect automatically follows the paragraph B97. On the other hand, B96D provides entities with discretion regarding disaggregation. Therefore, the change in RA due to changes in the risk adjustment for non-financial risk are recognized within the CSM unless an entity chooses to disaggregate pure non-financial risk from financial effects. If they are disaggregated, only the pure non-financial risk is adjusted within CSM, and the financial effect, including time value of money, is recognized in P&L in accordance with the guidelines outlined in B97. Accounting for this issue has presented a diversity of practices in Korea, leading to conflicting views that made it difficult to reach a conclusion. So in an effort to deepen our understanding and interpret the intentions behind the standards, we engaged in discussions with some ISB staff. The insights gained from the discussion were consistent with View B being appropriate, which was also in line with the KASB's analysis. In developing the risk adjustment requirements in IFRS 17, the ISB recognized the challenges that companies face in measuring the risk adjustment for non-financial risk, as well as the variation in measurement approaches observed in practice. As a result, the ISB decided to provide flexibility. If insurance finds it difficult to distinguish the financial components from the changes in the risk adjustment for non-financial risk, they're allowed to adjust these financial components directly within CSM, rather than recognizing them separately in insurance finance income or expenses. In Korea, it was concluded that the issue had no impact on practice. On a personal note, it was instructive for me to learn that depending on the methodology used to measure RA, financial risk might be included in the subsequent measurement, and that it may be quite challenging, harder than I thought for some companies to distinguish the changes in discount rates. The third question relates to the assessment of the investment component. When a policy is terminated, insurance companies pay the policyholder a specified amount, known as the surrender value. Insurers recognize this amount as an investment component by excluding this amount from insurance revenue and insurance service expenses, and adjusting CSM for any differences between expected and actual payments. The accounting is consistent with the requirements of IFRS 17 for investment components. The question is whether the surrender value meets the definition of an investment component. KASB concluded that an investment component is defined as the amount that represents the accumulation in the account balance of insurance premiums paid by policyholder, similar to deposits in a savings account. Given that IFRS 17 does not prescribe a specific measurement method for the investment component, entities must determine the amount of the investment component by considering the principles outlined in IFRS 17. On this issue, KASB had no choice but to respond in principle, clarifying that the determination of the amount of the investment component is a matter of judgment, based on the specific facts and circumstances of the contract. So, has this inquiry and response had any practical impact? The answer is yes, indeed. On the next slide, let me explain the background to this. Let's take a look at somewhat unusual type of insurance product that has recently been sold in Korean market. It's a short-term payment insurance. This type of insurance has emerged amidst the intense competition within Korean insurance industry. Looking at the details of such contracts, the payment period is exceptionally short, usually ranging from 5 to 7 years. Premiums for this insurance are competitively priced, being approximately 10 to 40% lower than those of the standard type. It provides an additional bonus to policyholders who maintain their contracts for predetermined milestones, such as 5 or 10 years, encouraging long-term commitment. The graph provides a comparative analysis of the surrender value trends between standard and unusual contract types. While standard contracts show a steady increase in the surrender value over time, the surrender value of these unusual contracts remains negligible or zero until full payment, at which point the surrender value becomes significant. It is notable that some products, after being fully paid for in 7 years, exhibit a surrender value ratio of 98% at the 7-year milestone and remarkably increased to 130% by the 10-year mark. A surrender value ratio exceeding 100% means that for the policyholder, terminating the policy after having paid the premium in full results in receiving more money than what was paid in. Conversely, for the insurer, this implies an obligation to pay amounts that surpass the premiums received from the policyholder. These excess payments, instead of being derived from the accumulation of premium paid by the policyholder, are financed from the insurer's own resources. This accounting issue stems from the treating such payouts as investment components, leading to a scenario where related expenses are not adequately expensed. In addressing this matter, it was crucial to highlight that the assessment of an investment component should be based on the substance of the payments rather than merely the term surrender value. Therefore, entities are expected to consider as investment components only those amounts accumulated through policyholder premium payments similar to savings. The amount funded by the resources of the insurer should not be considered to meet the definition of an investment component.